This week, Canada's Deputy Prime Minister, full-time finance minister, part-time construction foreman, part-time NASCAR driver, Chrystia Freeland, announced the Canadian Mortgage Charter. During the Liberal Party's economic statement for 2023, Freeland tried to shed some light on the upcoming mortgage renewal stress that Canadian homeowners and mortgage holders in Canada will be facing, as about 50% of all outstanding mortgages in Canada are set to mature in 2025 and 2026. Now, like most announcements ever made in the House of Commons, this is old news. I'm going to try to break down what all of this means and what already kind of exists for Canadians in their mortgage wonderland. Number one, allowing temporary extensions on amortization periods for mortgage holders. That's already been happening. That started happening at the beginning to mid 2022 when the Bank of Canada started to raise interest rates, and homeowners with static variable rate mortgages started to see their payments, even though their payments were staying the same, they were starting to see more of their payment going towards interest and less going to principal. And already we were seeing by midway through 2022, some mortgage holders starting to creep into that negative amortization situation. So this is something that's already been happening. Number two, waiving fees and costs that would have otherwise been charged for mortgage relief measures. I mean, I don't even know what that means. I mean, if a lender was going to allow you to miss 3 to 6 months worth of payments during COVID, that was going to be interest on interest. But if you have extended amortizations, I mean, you're going to have to pay the piper. Number three, exempt insured mortgage holders from requalifying under the stress test when switching lenders at the time of mortgage renewal. This is something that was already announced weeks ago by OSFI, who regulates mortgage lending in Canada. And apparently this was something that could have always been done. It just wasn't communicated properly from the top down. But over the last few weeks, this is something that every lender is already allowing you to do. By the way, when you're coming up for renewal with your current lender, you don't have to renew on a stress test. But you also, if you have an insured mortgage, you can transfer to another lender without having to do that stress test either. Hey, just something to mention real quick while I'm in this part of renewal. In a couple of weeks, I'm going to be hosting a free 1-hour webinar for people who have their mortgages coming up for renewal to teach you some tips and tricks on how to better prepare for that mortgage renewal as it comes up. A lot of people think that they're restricted to the same lender or restricted to the same amortization that they have remaining. These aren't the case. There's a lot of options for somebody when they want to switch lenders and shop for a better rate, a longer amortization, maybe a better product. So click the link in the details down below, and I hope to see you on that webinar in the coming weeks. Anyway, back to the breakdown. Number four, require banks to reach out to their mortgage holders 4 to 6 months ahead of renewal to talk about affordability options for you in advance of that renewal coming up. Well, guess what? You guessed it. That's already happening. Lenders will generally reach out 4 to 6 months before renewal. Heck, I've even had lenders reach out to my clients over a year from renewal as rates are decreasing to see if the client wants to take advantage of an early renewal, maybe save a little bit of money with extending out their term at a lower rate. But just a word of caution, if you take an early renewal, if you're coming up for renewal and you take an early renewal and you're coming out of a really low rate already, just be cautious. That lender is going to start you on that new rate today, the day that you take it. So generally speaking, you're going to want to ride out until the end of renewal, but you want to hedge your bets. You want to have a backup plan in place. And again, we'll be going over that on the webinar. Number five, allowing borrowers to make lump sum payments to avoid negative amortization or sell their principal residence without incurring payment penalties. Again, over the past year and a half with these static payments and negative amortizations for people, you have been able to make lump sum payments. As a matter of fact, your lenders have been sending out letters, possibly emails or phone calls about making lump sum payments because of those ballooning amortizations. So again, this is kind of old news. The only little nugget in here that I will draw positivity to is the fact that they're stating that no incurred prepayment privileges prepayment penalties on your principal residence if you're going to sell. I'm going to assume that's not the penalty for the mortgage per normal breaking it before the term is up. I think what they're alluding to is the increase of interest costs because of maybe negative amortization. If you're forced to sell, maybe that's what you're not going to have to pay a penalty on. We'll see. And number 6, waive interest on interest when mortgage relief measures result in mortgage payments that fail to cover interest payments on a loan. I mean, I'm going to be honest, guys, this is a really tricky one. A contract is a contract. And if you signed a contract and you go into negative amortization and you're paying interest on interest, if it's in the paperwork, I just can't see banks walking away from that interest on the interest. Again, the piper's got to get paid somehow, but we will see. So in summary, this is old news. It's political smoke and mirrors, and the borrower has had options for the past year and a half to make good on lump sum payments and bringing that extended amortization down. And they'll continue to have options. Trust me, your lenders don't want to take your property. They just want to make sure they get their money that they're owed. And having a plan well ahead of renewal is what you really need to focus on, because if you have a year or two, by God, start planning today, because even if rates do continue to slowly fall, you could see yourself coming out of a 2 or 3% mortgage into a 5 or a 6% mortgage. We just don't know what the future holds. Guys, if you like this video, please like and subscribe. Leave me a comment down below if you are feeling positive about these Canadian Mortgage Charter news coming out of the House of Commons, or if you have any feedback for what maybe you're experiencing. Again, look for the link in the bio for my webinar on mortgage renewals and refinances, which is going to be upcoming, and I hope to see you on that call. Take care.